presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Market YouTube update. I'm Mo Ansari. This is for November 8th, Election Day 2022. Starting with the markets, I'm going to talk about the Fed. More Fed what might or might not do, and it will really depend on the inflation number. Talk a little bit about the market, the economy, look at technical analysis, where the market is, and then look ahead the week ahead. Let's start with the Fed. Fed expectation was last week that the Fed will stop raising rates somewhere around 4 3/4 to 5, but now that has gone up to about 5 1/4 is the expectation. That's what Goldman Sachs is looking for. They're looking for another 50 basis point increase in December, 25 in February, and then again 25 in March, raising an ultimate high of 4.75 to 5%. This is where it really gets tricky. How high will rates go? First news will be that the Fed is going to lower the speed at which they're raising interest rates. That is good news for the market. The Fed is still stepping on the brake, but just taking the pressure, reducing the rate of interest rate increases, the speed at which they're raising, which could be good news for the market, but that will depend on the inflation number. Looking at the market, earnings revisions, we're starting to see those. Again, earnings are still holding up, but I think they have to be revised downwards a little bit more than where we are. Cyclicals are doing a lot better than the defensive stocks have been. That's what we're seeing right now. So we'll see how this works. The dollar has been one of the strongest dollars we've seen in a long, long time. This is 2022. And that is why emerging markets have not done well. It's putting a lot of pressure on gold. It had put a lot of pressure on emerging markets. That's what we are seeing. But once the dollar peaks and starts to roll over, that could be a sign for gold to start going back up again, emerging markets to start going back up again. As you've seen from the webinar, we're 2 standard deviations away from the norm on how much the S&P has outperformed the emerging markets. But we need to see some strength in the emerging markets, the dollar rolling over, and the dollar does not go down until interest rates stop going up. That's really the key. You look at the market after the last rate hike, the markets have done well. But we are not expecting the last rate hike until February or March of next year. That's the only problem that we're seeing. So it could be a couple of more months before the market really takes off. Looking at the economy, we are starting to see the unemployment rate starting to go up, wages starting to come down. And as you've heard me say for the last year, we need to get unemployment up. So that's when we really start feeling the recession. That's when everybody starts to say, oh my God, a recession is here, cut back on spending. And that's when demand goes down, and that's what helps. That's when the Fed stops raising rates and the stock market starts to go up. You can see the growth has been slower, pre-pandemic growth, rate of growth, slower than current. So we are creating more jobs now than we were pre-pandemic. That's how strong the economy is. That's how much demand there is for labor. And as long as there's that much demand, that means people are spending. We need the services out there. But there are signs that we might be peaking. This is the participation rate. You can see it is starting to decline. You can see that this is the blue line is the jobs hard to get minus plentiful. That is starting to turn up. That means people are starting to get a little bit worried that they might not have enough jobs out there. So we could see this, as you can see, it's starting to turn back up a little bit on the upside right here. Unemployment still close to a historic low of 3.5%. So we have room for the unemployment. Again, if you'd like to get the daily edition of Market Wrap, just go to the App Store and download the app, which is you type in search for Market Wrap with Mo Ansari. Type this whole thing in, and you will the app will show up, and then you'll get it downloaded every day. Download the app, it's free. The broadcast is free, and you can get the daily edition of Market Wrap every day. Looking at the technicals, this is the interest rate chart. As the rates have gone up, we're sitting at about 4.12 today. You can see the 50 days right here. We came down, made a peak of about 4.3, and then dropped back down just below 4. But now we're starting to go back up. I still think we'll get to 4.5. That's the target on the upside on interest rates on the 10-year note. This is each one bar, and green and red is 1 day of trading on the 10-year note. S&P is looking much better than the Nasdaq, so let's take a look at the S&P. This is the 50-day moving average, the blue line, which is right at about 37.95. Today we closed at 38.29, so we're above the 50-day, but still below the 200-day. We need to get above somewhere around 40.50. That's on the S&P to say, okay, we finally made a bottom. Support is at the 20-day, which is 37.80. And then we have more support, obviously, at the lows at 34.91. Looking at the weekly chart, 2 weeks in a row, we've come up to the 20-week moving average, 3,900, failed there. We need to close above 3,900. We close above 38.28. It's the inflation and the number that comes out on Thursday, which is expected to be 7.9%. A number less than that, that would be good for the stock market. That means inflation is slowing. That means the Fed can slow the interest rate increases. That would be good for the market. A number higher than 7.9 would not be good for the market. Nasdaq, on the other hand, still below the 50-day moving average, right? 20-day, the blue line, 10,750, or the red line, and the blue line right here, 11,067. We closed today at 10,616. So we need to really get above 11,000 in the Nasdaq to really create some excitement. The Nasdaq is based on growth stocks. Growth stocks are discounted when interest rates go up. We have to see a stability in interest rates, or interest rates start to go lower, at least not going up. That's when the stock market or the Nasdaq could turn up. Again, we came up to a 200-week moving average 2 weeks ago, failed there, came back down. Support is still at the low, and we're just biding time. We need to get above 11.2, really above 11,000 to get excited. Crude oil market did go up a lot on excitement that China might be reopening. The Chinese government said, no, wait a minute, we're not going to reopen. We are going to continue to have zero COVID policy, but there might be some wiggle room there. That was reported by the Wall Street Journal. So we will see if that happens. If China starts to reopen the supply chain, that means oil. China will need more oil, and that caused this sharp rally. But today, with the reality coming that there might be a very slow reopening in China, that brought oil prices down. Below the 98, which is 200-day, above the 50-day, which is 86.16, we closed at 89.17, sort of going back and forth right here. Nothing dramatic in oil. We could see some good news, inflation slowing, some kind of relief or end of the war in Ukraine, some kind of interest rates coming down, gridlock in government, all of that could be good. And again, no one is expecting any of that good news, but if we do start getting some good news, the market is oversold and we could see it. Gold market is the one that is really, I was looking for a target of about 1,600, 1,615. We got as low as 1,618 last week, and then we took off, and today we closed at above 1,700. Dollar's starting to come down, and the interest rates were down today. Is the gold market telling us something? That the Fed might start to take the foot off the brake? That we might see getting closer to peak in interest rates, consequently a peak in the dollar. When the dollar starts to go down, gold goes up. We'll have to watch gold carefully. Next resistance is 738. We can get above that. That would be a good sign that 1800 is the 200-day. Those are looking at the market, mixed market, back and forth. As long as we don't go to new lows, we can get above some resistance. That would be good, but it'll depend on Thursday's inflation number. If it comes out higher than 7.9, market comes back down. Lower than 7.9, market, I think, will head higher. Again, if you'd like to get my views on a daily in your mailbox, in your email box, all you have to do is go and sign up for my Market Minute, and you'll get it in your mailbox on a weekly basis. Looking at the week ahead, I think the elections, how they go today is going to have an impact on the market, and then inflation is going to have an impact. Those are my views. Those are my thoughts on November 8th. I will talk to you next week. Until then, good trading.
This This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.